Hi, my name is Willy, and welcome to our part 4 of our 4-part series of inflation, interest rates, and the economy. Do stay tuned for more as we discuss how interest rate could actually affect you. Now, how actually would a high interest rate affect you? High interest rate actually means that everything else might get expensive in terms of monetary factors or monetary aspect of things. So we're going to recap a little bit on what we've been discussing in our previous part is whereby right now we are actually in a high inflation scenario. When a high inflation occurs, the central bank will actually increase their interest rates. However, interest rates right now is being increased at a rapid rate, whereby right now we may actually even experience the side effects of things. So when we increase interest rate, this will actually lead to a higher deposit rate as well as higher lending rate. But when everything increases too rapidly in terms of interest rate, this may create a sort of a shock into the market. So what would I even say about a shock that might happen? So now we're going to look at this point here. Now, as of right now, we're actually currently experiencing interest rate hike era, whereby interest rate is actually rising. But at the same time, interest rate is actually rising at a faster pace as compared to previously. So as I've mentioned before, when interest rate rises too fast, this will actually create an economic shock. An economic shock is due to spending goes down rapidly or at a faster rate in a short period of time. So imagine this case. I am a business owner. Right now, I can actually see that businesses is doing good, and the demand is actually there, and the demand is actually quite high. So as a business perspective, I may produce more goods in anticipation for higher demand in the future. However, right now, the central bank actually increases interest rate at a faster pace. So at a point of time whereby I have produced this much of goods, it may actually lead to a lot of goods not be able to sell well, because as the interest rate rises, a lot of people actually tend to save their money and would tend to spend less on goods. This would actually lead to a very much of a rapid decline in terms of the demand. So in terms of that, business activity may actually decline rapidly as spending goes down super rapidly. And due to this, it may actually causes an external shock towards the business itself, whereby the inventory that they have produced in anticipation of a higher demand would be oversupplied. So when it oversupplied in the market, some of the goods may not last for long. So these businesses may actually incur losses in their cost itself and also in their production itself. And this will actually lead to even more negative side of things, whereby they may actually lay off their employees if it's get way too worse, or even a recession. So overall, although hiking interest rate may actually help to circumvent inflation from getting too high, but when interest rate actually rises too rapidly or too fast at a short period of time, this will actually create an economic shock. An economic shock whereby, in this case, it may not be reversible and it may not be fixed in a short period of time, and thus everything might go down the drain even further thereafter. So this is one of the discussions that I have with among myself and other analysts as well, and this is my point of view of things on how it could actually affect you. So when things go south and when the recession actually kicks in, this will actually affect you in terms of a lot of things. And one of them would be a very worst case scenario is layoff or even economic downturn, whereby it could actually affect you in a lot of ways. So for now, what we could actually do is just to sit back and wait and hope for the best. A lot of decisions that is being made by the central bank actually depends on the economic data itself. Thus, if the economic data actually reflects the the effects that central bank hopes to see, whereby the spending actually goes lower, inflation actually goes lower. Thus, we may see a good side of things in terms of rapid rise in interest rates. However, if inflation still remains at a very high level, then central bank may even take a sharp turn to increase interest rate further, and thus everything may eventually go south if the economy cannot sustain it anymore. And this ends our part 4 of our 4-part series with regards to inflation, interest rates, and the economy. Do subscribe to ZFX on YouTube. I'll see you guys again soon. Goodbye.